We're going to look at Franklin Covey, and this company provides time management training and assessment services for organizations and individuals. So it's a consulting company. What I do is I run my personal discounted cash flow model that I created, and I try to figure out the real value of the company's stock using their financial information and looking at the capital structure. I also look at the financial ratios of this company and show you the entire process, so it's like we're doing it together. Let's get started with the model. This company has a market cap of $253.1 million, so it's a pretty small company. And then they're trading at $18.24, so that's one share of stock, a little over $18. And to value a company, you have to estimate the future free cash flows and then discount that number back to today's value. And that's exactly what I'm doing in this video. And now I'm going to pull their actual free cash flows, because that's part of the model, along with a lot of other things. Now I'm going to go to the income statement and pull their net income, which is the profit and loss. And then I'm going to pull the revenue, which are the sales for each year. And it looks like the numbers are pretty steady, at least the sales are. Their free cash flow is up and down, but it's positive every year. And their free cash flow is above their net income, which is good to see. The income statement reports a lot of non-cash items like depreciation, and that brings down their income, and sometimes it does become negative. Although they're providing positive free cash flow, so that's what you want to look at, the cash, not so much the net income. Let's look at their capital structure to get more information. We need the interest they pay on their debt, that's $2.4 million. That's on the income statement. Let's go to the balance sheet to see how much debt they have. We'll go to the liabilities section. And the current debt is $5 million. That's debt due within 1 year. Long-term debt of $15 million. That's debt due after 1 year. They pay a pretty high interest rate, 12%. Interest payments are tax deductible. So let's go back to the income statement. As you can see on the income statement, in 2019, they paid more in income taxes than they made in income. That's because of accrual accounting. They're looking at prior years. So sometimes it's hard to look at the income statement. 2016 seems to be the best year. They made $12 million and they paid $4.9 million in taxes. It's still a pretty high effective tax rate. And the cost of debt is 7%. Now let's get the cost of equity. We need the beta. The beta is how volatile the stock is relative to the entire market. And they have a 1.56 beta. So the stock moves about 1.5 times the market. Let's go back to the balance sheet to get their current assets. And current assets are mainly cash, accounts receivables, and inventory. And we need this to calculate the current ratio later. That's $119 million. And then we need the current liabilities also to calculate the current ratio later. That's debts and payables that are due within 12 months. That's $103 million. And the equity is assets minus liabilities. And that's the value of the company according to the balance sheet. Let's go back to the income statement, get their earnings before interest and taxes. That's $2.7 million. So EBIT is how much money the company makes on its operational business, but before paying interest on its debt and before paying income tax. Let's look at the capital structure of the company. The cost of debt is 7%, they have 20% debt. The cost of equity is 14%, and they have 80% equity. So the WACC is about 13%, which is a blend of the cost of debt and cost of equity. That's the percent it costs this company to obtain financing, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all years past year 4. That's $369 million. But we have to discount these cash flows back to today's dollar amounts. And we discount them using the weighted average cost of capital. And the discounted numbers are here in green. When we sum these numbers up, we get the value for the entire company of $343 million. We divide that number by 14 million shares, and we get an intrinsic stock price of $25. They're trading at $18, so they're trading at a 26% discount. So it's a buy according to the model. Let's see what Simply Wall Street values the company at. They're 41, they're much higher, so they're saying the stock is really undervalued. Let's see where the stock has been trading, and it looks like it was touching almost $40 a few months back, but it's dropped a lot. Consulting services were probably really affected with coronavirus. This company may still struggle this year and next, but hopefully when things open up, they'll do a lot better. Let's look at their financial ratios. Negative PE, great price to sales, and good price to book. PE is stock price over earnings per share, and earnings per share is net income over shares outstanding. Negative net income they reported in 2019. So that's why they have negative PE. So we can't look at this ratio. When a company has a negative PE, people say, look to the price to sales ratio. So we'll do that. The price to sales ratio is stock price over sales per share. And to get sales per share, it's revenue over shares outstanding. And that's 1.1. And it said a price to sales ratio 1.0 below is really good value. 1.1 is still really good. I like to see below 2.5. So they're doing really well in this category. They're providing a good return on their sales relative to their stock price. Price to book of 3.1, that's stock price over book value per share. And to get book value per share, it's equity over shares outstanding. So that's a good ratio. I like to see below 3.5, they're 3.1. They have a current ratio of 1.2, which is good, and negative ROE. Current ratio is current assets divided by current liabilities. So they can cover their current liabilities. And ROE is net income over equity. Remember earlier they have negative net income? Let's look at their interest coverage ratio. They can just cover their interest payments. That's EBIT over interest expense. So this is how much money they earn, $3 million from their operational business. But their interest on their debt is $2 million. So they could just pay their interest payments. That's a bit concerning. So they're going to have to take on more debt to get through this difficult time. They have debt of only 20%, which is great. This company provides a really unique service, and when times are good, it seems like people are using their service, but in times of coronavirus and difficult times, not as many people are going to be using their service. So time will tell with how this company does, but I think if they get through the pandemic, they'll be doing just fine. Thanks for watching the video. Leave a comment.